Are you tired of your money just sitting in your bank account, losing value every day? Do you think investing is only for the rich or too complicated to start? What if I told you that with just a few dollars, you could make your money work for you, even while you sleep? The truth is, investing is not just for Wall Street experts or millionaires. It's for everyone, including you. And by the end of this video, you'll know exactly how to start investing smartly, even if you're starting from zero. No complicated jargon, no confusing charts, just clear, simple steps to help you grow your wealth. So stick around, because this could be the first step toward your financial freedom. Most people think that saving money is enough to build wealth, but the truth is, it's not. If your money is just sitting in a savings account, it's actually losing value due to inflation. Let's say you had $1,000 sitting in your bank account 10 years ago. With inflation, that same $1,000 can buy much less today than it could back then. Meanwhile, if you had invested that money in a simple index fund, it could have grown significantly over time. This is why investing is essential. It allows your money to grow instead of just sitting there, doing nothing. The best part? You don't need to be rich to start. Investing is how the rich get richer, and today, I'm going to show you how you can use the same principles to start building wealth, no matter your current financial situation. Before you jump into investing, you need to know your options. There are different types of investments, each with its own risks and rewards. Let's start with stocks. When you buy stocks, you're purchasing a small piece of a company. If the company grows, your investment grows. Stocks are great for long-term investors looking for higher returns, but they can also be volatile. If you don't want to pick individual stocks, there's a better option for beginners: ETFs. Exchange-traded funds are like a basket of different stocks, which helps reduce risk. Instead of betting on one company, you're investing in an entire sector or market. Then we have bonds, which are more stable. When you buy a bond, you're essentially lending money to a government or company, and they pay you back with interest. Bonds are lower risk, but they also have lower returns. Now let's talk about a trend that has caught a lot of attention: cryptocurrencies. While they have high growth potential, they are also highly volatile. You should never put all your money into something as risky as crypto, but it can be a small part of a diversified portfolio. Another great option is real estate investment trusts, or REITs. They allow you to invest in real estate without actually having to buy properties. All of these options can help you grow your money, but the key is understanding which investments align with your goals and risk tolerance. Now that you know the different types of investments, let's talk about how you can start, even if you don't have a lot of money. The first step is to open an investing account. There are plenty of beginner-friendly brokerage apps that allow you to start investing with as little as $5 or $10. You don't need thousands of dollars to get started. The most important thing is to build the habit of investing consistently. Instead of spending $5 on coffee every day, imagine putting that $5 into an ETF or stock. Over time, those small investments can turn into thousands of dollars. Another key concept you need to understand is compound interest. When you invest, your money earns returns. Over time, those returns start earning returns too. It's like a snowball effect. If you invest just $100 per month and get an average return of 10% per year, in 30 years, you could have over $200,000, even though you only invested $36,000. That's the power of compound interest, and it's why starting early is so important. A lot of beginners make mistakes that cost them money, and I want to make sure you don't fall into the same traps. One of the biggest mistakes is investing without understanding what you're buying. People see a stock trending on social media and rush to buy it without doing any research. That's a great way to lose money fast. Another mistake is waiting too long to start. Many people think they need to wait until they have a high income to begin investing, but that's not true. The earlier you start, the better. Then, there's the common mistake of following the crowd. When the market is going up, everyone wants to buy. But when it crashes, people panic and sell. This is the exact opposite of what successful investors do. Instead of trying to time the market, focus on long-term investing. And finally, don't put all your money into one single investment. Diversification is key to reducing risk. Imagine if you had put all your money into a single stock that later crashed. You'd lose everything. But if you spread your money across different assets, you protect yourself from major losses. Now that you understand the basics of investing, there's only one thing left to do: take action. Investing doesn't have to be complicated. Start small, stay consistent, and let time do the work for you. The best time to start was yesterday. The second best time is today. So what's stopping you? Open an investing account, pick your first investment, and begin your journey to financial freedom. And before you go, let me know in the comments, which type of investment interests you the most? Stocks? ETFs? Real estate? I'd love to hear your thoughts. If you found this video helpful, don't forget to like and subscribe for more content on building wealth and making money work for you. See you in the next one.